You were never meant to pay it off. Not because you can't, not because the numbers don't add up, but because the moment you pay it off completely, the moment that balance reaches zero and stays there, you quietly stop being useful to the institution that lent you the money in the first place. Think about what that means for a second. You spend years making payments, disciplined payments, on time every month, sometimes a little extra just to feel like you're getting ahead. And all along, you've been told that this is the right thing to do, that paying down debt is a form of financial virtue, that the goal is freedom from what you owe. But inside the system that issued your loan, something different is being tracked. Not how much you've paid, not how responsible you've been. What's being tracked is something far more revealing and far more valuable to the institution watching you, which is the pattern of your behavior across time. And that pattern, the longer it runs, the more it's worth, not to you, to them. That's the thing no one says plainly. The bank's ideal customer is not the one who pays everything off and walks away. The bank's ideal customer is the one who keeps borrowing, keeps repaying, keeps borrowing again, predictably, reliably, indefinitely. That customer is not in debt in the traditional sense of the word. That customer is in a relationship with debt, a managed, profitable, quietly permanent relationship. And the longer that relationship lasts, the higher the value assigned to you inside the system. You didn't walk into a bank one day and choose to be a long-term revenue asset, but somewhere between your first credit card and your current mortgage, that's what you became. This video isn't going to tell you to rage against that. It's not going to offer you an escape route or a 5-step plan. It's just going to show you what's actually happening, clearly, slowly, without the language the system uses to describe itself to you. Because once you see it, really see it, the experience of owing money changes in a way that can't be undone. Walk through the average Saturday morning in any mid-sized city and you'll notice something that's easy to overlook because it's so ordinary. People are managing money quietly, continuously, almost unconsciously. There's a man at a coffee counter paying with a credit card for a $4 drink, earning points toward a flight he may or may not take, accumulating a balance that he'll pay down this month and rebuild again next month without ever quite noticing that the cycle has been running, uninterrupted, for 11 years. There's a woman in her early 40s who got a letter last week from her mortgage company congratulating her on 7 years of on-time payments. She felt something reading that letter, a sense of reliability, of being seen as trustworthy. But she didn't examine the number at the bottom of the letter too closely, the one showing how much of her equity still belongs to the institution rather than to her. She put the letter in a drawer and made dinner. There's a couple in their late 20s at a furniture store deciding between paying cash for a couch that costs $800 or financing it at 0% for 24 months. 0% sounds like a gift, but it also means opening a new credit account, which means a soft pull on their credit file, which means their borrowing profile just became slightly more complex. They take the financing. It costs them nothing today. None of these people are being reckless. None of them are making choices that look, from the outside, like mistakes. They are doing what people do with money in the world that currently exists, using credit as a tool, managing payments, navigating the financial infrastructure built around them. But if you watch the pattern long enough, something becomes visible that isn't obvious from inside any single transaction. The system isn't designed around what these people want, it's designed around what they predictably do. The man with the credit card isn't a customer in any traditional sense. He's a recurring revenue stream with a credit score attached. His behavioral pattern, spend, pay, spend again, never quite zero, never quite overextended, is the pattern the system was built to encourage and sustain. The woman with the mortgage isn't being celebrated for her discipline. She's being retained. The letter she received was a retention tool, a reminder that she is a valued participant in an arrangement that still has many years left to run. The couple with the couch financing isn't getting a deal. They're being onboarded. Every account opened, every relationship initiated with a 0% offer is the beginning of a data profile that will follow them for decades and influence what they're offered, at what rate, at every financial decision point in their future. And here's what's worth sitting with for a moment. None of these behaviors are secret. None of them are forced. People choose to do these things freely, rationally, with reasonable information available to them. But what they're choosing is not quite what they think they're choosing. They think they're managing debt. What they're actually doing is building, month by month, payment by payment, account by account, a profile of themselves that the financial system reads as something they never intended to create. Here is the belief most people carry into every financial decision they make. Debt is a problem to be solved. It's borrowed money, you owe it back, the sooner you pay it off, the better. Zero debt means freedom, more debt means vulnerability. The goal is always to reduce the balance. The dream is to owe nothing. This is the framework almost everyone operates from. It's logical, it's intuitive, and for most of human history, in most contexts, it was essentially correct. But it describes a world that is not the one you're actually living in. Because in the financial system that currently exists, not a hypothetical one, not a predatory one, just the ordinary functioning one, debt that is managed responsibly over a long period of time does not make you weaker. It makes you more valuable, more legible to the system, more trustworthy in the specific way the system defines trust, more worthy of larger amounts of credit at better rates for longer terms. In other words, carrying debt well makes you an increasingly desirable borrower, and desirable borrowers don't pay everything off and walk away. They borrow more.
This is not a conspiracy. It doesn't require bad intentions from anyone involved. It's the natural output of a system that is designed to assess creditworthiness. And creditworthiness, by definition, is not about having no debt. It's about having the kind of relationship with debt that makes future lending appear safe. Someone with no debt history is not, to a bank, a safe customer. They are an unknown, an entity without a behavioral track record. The bank cannot easily predict what they will do. Someone who has carried a mortgage for 12 years, maintained a credit card balance that never maxes out, made every payment on time, and occasionally taken out a personal loan they paid back in 18 months, that person is extraordinarily predictable. Their behavior has been observed across hundreds of data points, across multiple economic conditions, across years of real financial pressure and real financial decision-making. They have, in the language the system doesn't use with you, they have demonstrated consistent profitability to lending institutions over an extended period of time. And profitability, sustained profitability, is what gets rewarded, with access, with approvals, with rates that make continued borrowing feel entirely reasonable. This is the inversion. Debt is not the obstacle between you and financial security. For the system that issued your debt, your willingness to carry it is the evidence that you are financially secure. The longer you owe, the more clearly you signal that you know how to manage an obligation without defaulting on it. That signal is what the system is built to detect and reward, not your savings rate, not your investment portfolio, not how close you are to owning your home outright. Your relationship with debt, its length, its consistency, its managed regularity, is what makes you legible. And the more legible you become, the more doors open. That's not a metaphor. That's how credit scoring works. That's what the algorithms are measuring. That's what the offers in your inbox are responding to. Understanding what's happening inside a bank doesn't require a finance degree. It requires setting aside the language banks use to describe themselves and looking instead at the mechanics. A bank makes money by lending it. That's the core of it. The difference between the interest rate at which it borrows money and the interest rate at which it lends money is where the margin lives. Everything else, the branches, the apps, the customer service, is infrastructure built around protecting and expanding that margin. When a bank approves a loan, it is making a prediction, not a charitable act, not a service, a bet. The bet is that you will repay the principal plus interest on the agreed schedule without defaulting. The bank uses your credit history to estimate the probability that it wins that bet. A high credit score is not a reward for being responsible. It is a signal to the institution that their prediction is likely to be correct. It says in quantified form, this person has an established pattern of debt repayment. Lending to them carries a predictable, acceptable level of risk. This is why your credit score improves when you carry debt responsibly over time. Not because the system respects your discipline, because your track record reduces the institution's uncertainty. And reduced uncertainty is worth money. That reduced uncertainty is what gets passed back to you as a lower interest rate, a higher credit limit, a pre-approved offer. The credit score as a mechanism is not designed to benefit borrowers. It is designed to make borrowers more or less attractive to lenders. Borrowers who understand this are navigating the system as it is. Borrowers who think their credit score is a measure of their financial health are navigating a map that doesn't quite match the territory. The territory looks like this. Banks do not want customers who pay cash. Cash customers do not generate interest income. They don't build credit profiles. They don't become more legible over time. They are, from an institutional standpoint, not particularly interesting. Banks want customers who borrow, repay, and borrow again consistently across decades. Not because they're in financial distress, because they've internalized credit as a tool and use it regularly, the way someone uses a smartphone, not as a last resort, but as a default mode of operating. The ideal customer from a bank's perspective always has some balance outstanding, not dangerously, not in default, just present, just earning interest, just continuing the relationship. There is a whole architecture built to create and maintain that ideal customer state. Credit card reward programs are not gifts. They are incentive structures designed to make card usage feel beneficial, to ensure that the habit of paying with credit rather than cash becomes deeply automatic. The reward is real. The behavioral conditioning that produces it is also real, and the net result is a customer who uses credit continuously, earns marginal rewards, and generates steady interest income on any month they don't fully clear the balance. Minimum payment requirements are not designed to help you pay down debt. They are calibrated to extend the duration of the debt as long as possible while keeping you technically current. Paying the minimum on a credit card balance is not a path to zero. It is a path to years, sometimes a decade or more, of carrying the same general obligation while paying significantly more than you originally borrowed. Pre-approved offers arrive in your mailbox not because a bank randomly selected you, but because your behavioral profile was run through a model and returned a result that indicated you were likely to accept, likely to repay enough to not default, and likely to generate a meaningful amount of interest over the life of the account. You were targeted, gently, profitably, with offers that were carefully calibrated to your observed financial behavior. This isn't malevolent, it's operational. It's what a lending institution does with the information it has access to you. And the information grows richer the longer you're in the system. The older your credit file, the more data points it contains, the more accurately the institution can model your future behavior, the more confidently it can lend to you, and the more it stands to earn from that lending over time. There's a particular moment that some people describe when talking about their relationship with money.
It's not a dramatic moment. It doesn't happen during a financial crisis or a late-night moment of panic about a bill. It tends to happen quietly while reading something or in the middle of an ordinary financial transaction, when the frame through which they've been seeing the system suddenly shifts. One way to describe it: they stop seeing their credit score as a personal achievement and start seeing it as a profile. The profile is accurate. It reflects real behavior. It is not inaccurate or unfair in any direct way, but it's not about them, not in the way they had assumed. It's not a reward for their responsibility. It's a tool the system uses to decide how profitable it expects them to be. And once you see that distinction, it changes how the next pre-approved offer feels. Not outrage, not paralysis, something more like clarity. The offer arrives, you understand why it arrived, you understand what it's designed to do, and you can evaluate it on those terms without the layer of flattery that was always embedded in the language. The language of credit is full of flattery. You've been pre-selected, you've qualified, you're a valued customer, your loyalty is appreciated. These phrases do something to the person reading them. They create a sense of reciprocity, of being seen, of having earned something. That sense is not accidental, it is engineered. The recognition you feel when a bank tells you you've been pre-approved is drawing on something real: your desire to be trusted, to be seen as reliable, to have your discipline acknowledged. The institution isn't lying to you, but it's also speaking to an emotional register that exists specifically because it makes you more likely to act. Understanding this doesn't mean becoming cynical about every financial offer. It means developing a different kind of literacy, one that reads the offer for what it is rather than for what the language suggests it is. There's also a subtler thing that becomes visible once you start looking. The financial system does not benefit from your financial anxiety, but it also does not, in most cases, benefit from eliminating it. A certain level of financial anxiety, enough to keep people paying on time, enough to keep them slightly worried about their credit score, enough to make them respond to communications from their lenders, is operationally useful. Not in a conspiratorial way, in a structural way. A system designed around consistent repayment benefits from borrowers who take repayment seriously, and seriousness that shades into anxiety produces the same behavioral output as genuine discipline, often more reliably. The person who misses a payment because they weren't worried enough is less profitable than the person who lies awake at night making sure they don't. From a purely behavioral standpoint, the anxious borrower and the disciplined borrower may look identical to the system observing them, but one of them is carrying a psychological cost the system never asked about and will never compensate. That cost is invisible to the model. It doesn't show up in the credit file. It isn't priced into the interest rate, but it's real and it's worth being aware of. Because one of the quieter achievements of financial literacy isn't learning to maximize every return or optimize every account. It's learning to distinguish between financial discipline that serves you and financial anxiety that serves the system without benefiting you at all. You can repay everything on time without losing sleep over it. You can maintain a strong credit profile without giving it more psychological weight than it deserves. You can participate in the credit system with full awareness of how it works without either rejecting it or being operated by it. That calibration, calm, clear, unhurried, is what financial self-possession actually looks like. There is a version of this that ends with a prescription, a set of things to do differently, a call to reorganize your relationship with debt based on what you now know. That's not where this ends. Because knowledge about a system doesn't automatically change your relationship with it. And more importantly, not everything in the system is designed against you. Some of it works in your favor if you use it clearly. The same mechanism that makes long-term debtors more valuable to lenders also, if navigated thoughtfully, gives long-term borrowers access to capital at lower costs than people without credit history. That's real. That's usable. What changes when you understand the system isn't necessarily your behavior. It might not be nothing more than your experience of the behavior you are already going to have. You were going to take out a mortgage. Now you take it out knowing that the mortgage is also building a profile that will make you more attractive to the lending system for the next 20 years. You're not trapped by that. You're participating in a relationship with clear eyes. You were going to carry a credit card. Now you carry it knowing that the rewards program is an incentive structure, not a gift, and you can decide for yourself whether the incentive is worth the behavioral nudge it's designed to produce. You were going to feel something when a pre-approval arrived. Now you'll feel something slightly different. Not suspicion, just a quieter recognition of what the letter is actually communicating underneath the language of flattery. The system doesn't need you to understand it in order to function. It functions regardless. The understanding is for you, not because it changes the rules of the game, but because it changes the quality of attention you bring to playing it. Debt is not the opposite of freedom. It's a financial instrument with a cost attached, which is sometimes worth paying and sometimes isn't, which serves the institution issuing it in specific ways and which serves you in specific ways that are worth understanding separately from the ways it serves them. That's the whole thing, really. The bank values you the longer you owe it. Now you know why. Now you know what that valuation is actually measuring and what it has nothing to do with. What you do with that is yours entirely. If you made it this far, thank you. Genuinely. This is the kind of material that asks something from you. It doesn't entertain you with drama or reward you with shortcuts. It just asks you to sit with a set of ideas about how money actually moves and why. If that's something you came here for, I'm glad this found you. If something in here shifted the way you're thinking about your own financial situation, not dramatically, just quietly, I'd be interested to hear what it was. Leave it in the comments if you're willing. Not a debate, not a question that needs an answer, just what you noticed. And if this felt like something worth returning to, you know where to find it. Take your time with it.